Hello, friends. Greetings to one and all. I am CA Meenu Agarwal, here again to share with you a topic on international taxation. I am very obliged to the CA Sansaar team and especially Vivek sir for giving us this opportunity and this platform so that we can share our views and speak on the technical topics. So let's start with today's topic. We are going to cover this topic of international taxation in various parts. Today, I'm going to cover only the basics or the overview of international taxation. So, international taxation today, every other person hears and speaks about international taxation. Every other person wants to know what is this international taxation, how do we apply international taxation. With the pandemic, we have been able to reach out to globe very easily. We are, uh, I being in India, I'm able to reach out to any other place across the globe and I can expand my business. So in this kind of a scenario, it becomes very important that you know how your transactions, how your business is going to be taxed. So this kind of transactions and the taxation of these kind of transactions will be covered by international taxation. So what is international taxation? In a very general and a layman language, if I have to speak, if I being a resident in India, I have a transaction outside India, then how do this? These are called the cross-border transaction. How are these transactions being, taxed? What is it that? How much is the tax I'm liable to pay in this country? How much is the tax I'm liable to pay in the other country? This is what the international taxation is all about. So basically, international taxation is nothing but the rules and regulations that one needs to keep in mind while having a transaction with the other countries. If I take you to the understanding or the explanation as given by OECD, it says international taxation refers to the treaty provisions relieving international double taxation. So we need to understand, when is this international taxation applicable? Is it applicable to a limited number of transaction? Is it applicable to a specific kind of transaction? So let me give you a scenario, two scenarios basically over here. Mr. A, who is an Indian resident, earns consultancy income from USA, so which is the other country. I have a second scenario where Mr. B, who is a resident of UK, earns income through the sale of goods in India. So now the question comes is whether the international taxation what we are referring to will cover both these kind of transaction, or is it going to cover only one type of transaction. So here we will talk about what are the broad dimensions where the international taxation will be covered. International taxation covers both the scenarios as I just gave you the example. That is, it covers the taxation of residents who's who basically earn income in the foreign country. It also covers a scenario where a non-resident is earning income in in the other country. So for example, if a non-resident, like in my example, Mr. B, who is a resident of UK, is earning some income in India. So this transaction will also be covered. And if an Indian is earning any income outside India, even that transaction will also be covered. So basically, we are going to understand what are the rules and regulations that govern all these transactions. Now, before we enter into the technicalities, let me clear again that today we are going to learn only the basics, very basics terminologies that are used in the international taxation part of it. How is the law embedded? How is the law basically incorporated? What is the domestic law? What are the key points that we all need to keep in mind? And many more things to come in the subsequent parts. So when there is a transaction, like in my example, when there is let me take the example of Mr. A, who is a resident in India, who earns a consultancy income from USA. So in this kind of transaction, one need to understand whether this transaction is taxable or not, which country has the right to tax this transaction, and what are the tax rates. Now there is another part which says whether the transaction is actually the amount involved or the transaction is entered at the correct amount or not, which is called the arm's length price, which is a topic of transfer pricing altogether being another ocean. That is also part of international taxation, but today we are going to mainly cover and understand whether this transaction is taxable or not. If it is taxable, in which country has the right, and how do you overcome the double taxation. So in this transaction there are three limbs, there are three act or provisions which one need to consider, like Mr. A, who is a resident in India, shall be subject to the domestic tax provisions, that is the Indian income tax. Mr. A, who is earning consultancy income in USA, he need to also look into the foreign tax provision which shall be applicable on him with respect to that consultancy income. Right now, because you are subject to tax in two different countries, whether you have any law or any provisions which help you to avoid these double taxation, so there you take the help of tax treaty provisions. So what we are going to cover today is to involve and indulge and understand more about what exactly is tax treaty, what are the terminologies that we are going to that are very important in the day to day life to understand with respect to tax treaty. Tax treaty in a normal language is also called double taxation avoidance agreement. So first thing what a person need to understand is what is the meaning of a treaty. If I have to tell you in a very layman language again, it means a agreement between two persons, but here because we are talking about a treaty, it will be between two countries in a certain form which prescribes the rules and regulations that govern the transactions. So Vienna Convention is one of the very known convention and which is referred to when you have to read and understand about the double taxation avoidance agreement. So it defines treaty as an international agreement between the states in written form and governed by the international law. Right. So in simple language, again, between the two countries there is an agreement in the written form which shall govern different transactions. Why such tax treaties? What are the features of such tax treaty? What a person is supposed to look into that tax treaty and conclude whether yes it is beneficial to it or not. Now, as I discussed with you, now I have in my previous example where I was talking to you about Mr. A, who is an Indian resident, has a consultancy income in USA. So now if you see, the same income is being taxed at two places, so you have this double taxation. So there are certain tax credit mechanism. You cannot avoid that okay, I'm not going to pay tax in USA, I'm not going to pay tax in India. No, there are certain mechanisms which have been incorporated in the tax treaty where it says that if you're paying tax in both the countries, we have incorporated certain tax mechanisms in our tax treaties which you can take into consideration while paying your taxes, so which is basically the tax credit mechanism. So this is one of the features of tax treaty. What is the other thing? Now suppose say Mr. A, like in my example, is a resident in India, and because he stays in USA for a certain period, he becomes a resident also in USA. So there is a dual residency. Now, as you all are aware that any person who is a resident, global income becomes taxable. So again, there is a challenge that he will be taxable in these two countries. How do you overcome this dual residency? That is again, you have to refer back to the tax treaties. Now if going forward, now if you have an income which, like, again I'll refer back to my example where the consultancy income is taxed in the USA, which is your source country. It is taxed again in India, which is your residence country. How do you allocate this taxing rights to India and to USA? Where should I look back to? You need to look back to the tax treaty or the taxation avoidance agreement between India and USA. So one of the features of this tax treaty is how are these taxing rights being allocated between the two countries. Now, because it is an international matter, there are various requirements between the authorities, judicial authorities, to exchange information. Now USA might want to know how many Indians are there who are working in USA and earning income from here, and vice versa. So this kind of exchange of information is also allowed through these tax treaties. There are certain anti-avoidance provisions also which are mentioned in the tax treaties. So these are the features. Going forward, when you read a tax treaty, there are certain terminologies which are used in used in these treaties. So one need to understand for them to get a hand on the double taxation avoidance agreement. So there are certain terminologies like home country. So in my example, Mr. A, who was an Indian resident. So if you see here, Mr. A, Indian resident. So the country in which he is a resident shall be called the home country, right? And he earns income in USA, consultancy income. So that becomes the host country, the country in which he has generated income, or it is called the source country, right? Now, if you read the DTAA, there are certain words used like contracting state. So, what do you mean by contracting state? Contracting states are nothing but those countries which enter into the treaties mutually after a mutual discussion. Enterprise of a contracting state. So they have to define as to whom these tax treaties are applicable. So they define it as enterprise of a contracting state. So any taxable unit, I won't term it as any person, but they use it like any taxable unit. So nothing but a person, individual, HUF, LLP, company. So these are called, they are referred as enterprise of the contracting state. Nowadays there's one very common terminology that has been used is MFN clause, nothing but most favored nation clause. This topic I'm going to cover very much in detail later on, but just to give a glimpse of it, today if I have entered into a treaty with, say, Japan, and I have certain rates fixed for withholding, and tomorrow if I enter into a treaty again with, say, some X country, wherein the withholding tax rate is way less than what I have entered with Japan. So this MFN clause allows me to take the benefit of these subsequent treaties. Much in elaborate, this is a very important topic we will be discussing little later on, but just the idea that these are more beneficial provisions that are entered on a later date, which can be considered for your transactions with the other country. So now that we have understood all these features and what are the important terminologies, are there any types of DTA, or there is only one format for the DTA? So there are two types. I won't say two, there are more, but mainly type are the limited DTAA and the comprehensive DTAA. So India has limited DTAA, wherein you discuss, or you incorporate and note down only about the restricted transactions. What I mean to say is it does not cover the all heads of income. It covers only certain transactions. For example, India has a limited DTAA with Pakistan, wherein the Pakistan and India, they have entered into with respect to only income from international air transport, not with respect to any other income. So if you have a limited if your treaty is limited to certain type of income, then that shall be called as a limited DTAA. Now, if you have a comprehensive DTAA, so the name itself suggests that it shall cover all types of income by between the two countries. So one of the example that I have given here is between India and New Zealand. So other countries also you have mostly these comprehensive DTAAs. Now, what are these double tax treaties? Double tax treaties, are there any? We read about the types of DTAA. Now, if anyone goes to any client and says that, okay, we need to see your purchase agreement, we need to see your do you have any agreement for consultancy? So there are different kind of agreement formats, correct? So here, how do we understand that what is the format of the double taxation avoidance agreement or these tax treaties? So do we have any treaty models? So the answer is yes, we have various treaty models, but the most common one are OECD model, UN model, US model. There is a very unique feature of this US model which we'll be discussing, and another one is Andean model. But most commonly use the OECD and UN model. Now, what is the difference between these models? Why are there different models, and why we need to refer to these kind of different? these models are applicable to different countries. Okay, so how is what we are going to see next. So now these here we are going to explain mainly about these three models. This is OECD, UN, and US. Let's understand first what is this OECD model. I have given a comparison table so you can see when is this OECD applicable, to whom is UN applicable, to whom is US applicable, right? So OECD model is mainly for these developed nations, whereas the UN model is for the developing nations. So this is how you distinguish, right? Now what is the principles that OECD follow? I'll come to US model a little later. First, let's see OECD and UN. So, OECD applicable to developed, UN model is applicable to the developing or less developed nations. Okay. So, what are the principles? Are the principles common between these two models? Again, there is a difference. For the developed countries, they follow the residence principle, that is in OECD, and for the UN model, they follow the source principle. So, in my residence principle, like the person need to be a resident for its income to be taxed, whereas the source principle, where you say if you earn any income over here though you're not a resident, then this country shall become liable to tax. So that is called residence and source principle. And then who are the members of this OECD model? Those developed nations, there are currently around 37 countries who are members of OECD. And where does India fall? If I have to talk from Indian point of view, where does India fall? India is a part of UN model. It is not a member of OECD model, but India is an observer of OECD model. What do you mean by observer? If you look into the double taxation treaties, most of the provisions India borrows from OECD. It only observes, and its treaty also includes certain provisions from the OECD model. But the most of the Indian treaties that India has entered into with different countries are in the UN model per se. So so India is an observer of OECD but follows UN. So there's a mixture. If you go through, as we discuss further, you will understand that it is a combination of both. Now, let's understand about US model. Now, US model is totally different. It is applicable only for USA. USA follows, US actually aligns this with the OECD model, has incorporated certain USA law practices, policies, rules, and regulations. And US does not follow any model. US follows only its own model for any further negotiation with other countries. Now that we have understood what is a tax treaty, what are the types of tax treaty, what are the features, l- we have been discussing double taxation avoidance agreement. Let us understand what is this double taxation. In my example, which I started with, started it in the initial one or two slides, where Mr. A is an Indian resident who earns the consultancy income from USA, right? Now, as because Mr. A is a resident in India, he shall be liable to tax in India, and also he shall be liable to tax in USA. So basically there are two countries who are charging tax on the same income, on the same income, right? Just because it is entered between two countries. So this is called double taxation. So double taxation is nothing but is a result of the tax laws of two countries for carrying on one or more economic transactions. So this is a transaction both the countries are charging, charging tax to me. So that's what I have illustrated here via a USA branch. So what happens in this is India is charging Mr. A because of the residency rule or the residency principle, that Mr. A is a resident in India, and hence whatever income he earns globally, he shall be liable to tax in India. USA is following a source rule, which says if you are earning any income because of providing any service or rendering any service in my country, then source rule will be applicable, and hence you have to pay tax in this country as well. So this is resulting in double taxation. But isn't it a kind of punishment that you are paying tax in two countries? you need to get some relief, right? So that relief is given by way of a double taxation avoidance agreement. How this relief is being claimed, how this credit is claimed, when do you claim all these credit, that we will discuss. But basically, the from a very layman language, double taxation avoidance agreement helps you to avoid this double taxation. It does not mean that you don't pay, or you don't you don't report this transaction in your returns. It means that if you're paying tax in two different countries, how can you take the credit of tax paid in one country in another country? So there are certain mechanism every treaty specifies, which we shall be discussing later on. When I say there are double taxation, again, this double taxation have two types. Oh my god, this international taxation, everywhere you have types, you have different models, you have various situations. That is why the basics, if your basics are very clear, then it becomes easy for you to understand any international taxation, understand which category it falls into. So that is why I'm trying to explain all these basic concepts. Now, even the double taxation are of two types. As you can see, it is juridical and it is economic. Now, let's understand each one by one. What is this juridical double taxation? I'll go back to my example of Mr. A. Mr. A, he's been he has got this consultancy income in USA. He's been taxed in USA and also in India. So that is nothing but juridical double taxation, which means a same person is taxed for the same income in different countries. Okay, we'll understand little later with examples, and how do you what are the provisions that are available to you, that you can take the credit and avail the benefit. But understanding of juridical double taxation is this. Now, the second type of double taxation is the economic double taxation. What do you mean by economic double taxation? Here, the income remains the same. It is taxed twice, but in the hands of two different people. The best example is the dividend. Dividend, which is declared, that was taxed by the company also, in the hands of the company by way of DDT. It was taxed even in the hands of the shareholders. So, when the same transaction is taxed in the hands of two different persons, then it is called as the economic double taxation. Now, because of these double taxation, there are certain conflicts that arise. Like we have already discussed, Mr. A, who is a resident in India, but the source of that consultancy income is in USA. So there is a resident and source conflict. So this is how you define these conflicts. That if a person is resident in both the country, then then there exists a resident conflict. Now, how do you overcome these conflicts? How do you where do you go back to? Which is the Bible that you go back to and say, oh my god, this saved me from this double taxation? That is this double taxation avoidance agreement. So few of the example or the conflicts that can arise because of this double taxation. First one is residence. That is, you have a simple double dual residency basically. And when you are a resident of any country, the residency the residency, because you are a resident, your global income becomes taxable. How do you overcome this? So go back to and refer to the tiebreaker rule, which is mentioned in the double taxation avoidance agreement between those two countries. Most commonly, it is I won't say most commonly, it is Article 4 in all the double taxation avoidance agreement, which specifies what are the criteria or what are the steps you need to follow to finally determine you belong to which country as a residence. So that is called the tiebreaker. Now, if it is not a residence conflict, that is, you are not a resident of both the countries, but you have a conflict which says, where you have, like in my example again, Mr. A is a resident of India, hence global income is taxable. Mr. A has consultancy income in USA, hence USA is taxing. So this is basically called you are a residence and a source conflict. That one country is a resident country, one is a source country. Hence there is this conflict. Now, how do you overcome this? please refer back to Article 23, which is the distributive rules. So when I said these double taxations are the answers to your questions, how do I overcome all this double taxation? Will I get any benefit or not? You have to refer back to the double taxation avoidance agreement and derive which is a relevant article in your case. It depends on fact to fact basis. Okay. So in this case, if your case is of a resident source conflict, go back to Article 23 and see which says about the distributive rule. How do you distribute such income, or how do you overcome this double taxation, right? Now, my case is neither of a residence conflict. My case is neither of a residence source conflict. My case is of a source conflict. Now, what is this source conflict? It sounds nice, you see. So, now both the countries says that I am going to tax this income because according to my law, the definition or the meaning of this particular income falls in my country, and the other country also says the source falls in my country, hence I am liable. I'm not considering the residency, but I'm just going to see the source. So how do you overcome that? Please visit Article 21. So these are the common articles in you will find in most of the DTAAs. You pick up any double taxation avoidance agreement, you will find these common bases you have. Now you need not have to crack your head, but just refer back to this, see if the facts match the scenario that have been mentioned, and determine how do you take the credit mechanism or the steps that have been mentioned. So now that Mr. A has paid tax in, say, USA also, has paid tax in India also. Now, I have been speaking about you need to take credit, you will get some relief. How do you know whether I'm liable for relief or not? Right? So, first thing you have to see is the country in which you have entered into such transaction. Does it have a double taxation avoidance agreement or not? Like for Mr. A, who is an Indian resident, he need to see whether India has entered into double taxation agreement with USA or not. Now let's take a hypothetical example that what happens if India had not entered into any agreement with that country where I have entered into transaction. In that case, no double taxation avoidance agreement is available, right? So you need to refer back to the domestic law, that is the Indian, Income Tax Act. You need to go back to that and refer what can you do. Once you refer back to the domestic law, there are certain provisions given in section 91 as to how do you take the relief to eliminate this cascading effect, tax on tax kind of thing. So that you are not being burdened with the double tax. So this is how you have to refer back to section 91. There is a process given, you need to follow that, and this is called unilateral relief, wherein you don't have a DTAA with other country. You need to refer back to the domestic law and enjoy the relief that is available. Now, if there is a DTAA between these two countries, my example again of Mr. A, there is an agreement, there is a DTAA between India and USA. How do I take relief? You need to see what is the credit mechanism given in that. You need to see, is there any mode specified, is there any quantum of tax relief that have been mentioned, is there any credit that can be claimed in the residency. What are the terminologies that DTAA specify between India and USA, and accordingly you have to take the relief. So if there is a DTAA between the two countries, and through that DTAA you're taking any relief, then that shall be termed as the bilateral relief. If I have to go back to Indian law, what are the steps? We have a very robust mechanism. There are a lot of steps mentioned. There is a procedure altogether. The credit mechanism can be either the exemption method or the credit method. So again, can't be covered in one day. We shall have a detailed discussion on how do you claim this relief, what are the documents you require, and how do you proceed further. But a basic understanding, unilateral and bilateral relief. Now, if you guys remember my first slide, which explained about the definition of treaty, I mentioned something like a Vienna Convention on Law. I just thought I'll just bring this to your notice because whenever there is an international taxation, somewhere or the other, you hear this word Vienna Convention. Now, what is this Vienna Convention on Law of Treaties, VCLT? Like, every religion has a book or a Gita in Hindus and a Bible for Christians. For international tax, VCLT is like a Bible. So what exactly is VCLT? Is it gives you all the principles, rules, regulation, how you need to interpret a particular article, how you need to interpret a particular transaction, when there is a treaty between the two parties, what are the interpretations that one need to look into. If the DTAA is not self-explanatory, where do you refer back to? Then that is the Vienna Convention of on law of treaties, where you have to refer back to. So it is nothing but an international agreement regulating treaties between the state. It is an international agreement that regulates the treaties. Okay, if it is not self-explanatory, you need to refer back to as to how do you see the rules, procedures, how do you interpret it, and come to a conclusion. There were 116 countries which have ratified this VCLT. It is regarded as one of the important instrument in treaty law and remains authoritative, guiding in disputes, over treaty interpretation. As I said, if the treaties are not self-explanatory, you refer back to Vienna. You have all these commentaries, even for the Indian law, you have different Ramaya's commentary where you refer back to and understand how do you interpret. So in the same way, the treaty, there is certain dispute in interpretations, you refer back to Vienna Convention and arrive at the conclusion. So I've given you a list of articles, which are relevant when it comes to the treaty interpretations. So these are certain which you can just refer back to for your convenience. Now, how is the tax treaty being structured? If I go back to my example again of India and USA treaty, so there are around 31 article 1, 2, 3, 4, 5, 6. Now they all have certain importance in itself. Like Article 1 defines the scope, Article 4 defines the residence, Article 5 defines the PE. So this entire structure of tax treaty has been divided into six parts. First is the scope, which covers Article 1, 2, 30, and 31. The definition part covers Article 3, 4, and 5, and there are substantive articles that is 6 to 22, something like if you have any royalty income, fees for technical service, interest income, dividend income, then Article 10, 11, 12, which describes all these as to what is the nature, what do you mean by royalty, what do you mean by interest, what do you mean by dividend, and how do you tax it, which country tax it. All that are called the substantive provisions, which are covered by Article 6 to 22. You have certain anti-avoidance provision, which are covered by Article 9 and 26. And like we have been discussing all over, how do you come over, or what is a mechanism for this double taxation or elimination of double taxation. You have this specifically given in Article 23 and Article 24 of the tax treaties. And you have certain other miscellaneous provision, that is the non-discrimination, or how do you collect the taxes, and in Article 27 and Article 24 respectively. So this is a basic framework of the tax treaties. Certain articles can be up and down. What I mean is there might not be a fee for technical service article separately as a Article 13. It can be in Article 12 itself. So the numbers can go plus or minus here and there, but the basic structure, how a tax treaty is basically structured, is in this form, which can be grouped into six categories, and the articles can be up to 31 articles. Now, when we were talking about Vienna Convention, we heard about the treaty interpretation. Now, if there is a clause, you have two countries. It is very much possible that the interpretation of what I interpret might differ from what you interpret. Right? The international taxation itself is nothing but about all this as to how do you interpret it. So there are two basic approach which have been given in the basic approach have been given for this treaty interpretation. Before that, let me give you a little background. Now, I'll take you to this example of Finance Act 2012, which had brought in amendments in various sections of the Income Tax Act. Okay, one such amendment was in the definition of royalty. Now, say suppose a treaty with USA was entered way before 2012. So now a DTAA which already exists, which has a royalty definition, right? And uh, and you have this law which has changed in 2012. So there is a provision which existed when you entered into treaty. There is a change in law which has happened subsequently. How do you interpret, or which clause you need to consider? Do you need to consider the one which you entered into, the one which existed when you entered into the treaty, or the subsequent one? So these kind of interpretation fall into two buckets. One is the static approach. Static approach meaning when you entered into the treaty, whatever the meaning were existing at the time of signing the treaty, that approach you will follow, which is called the static approach. And the second option which is available is when you are applying the treaty, which means in 2012, suppose there is a royalty transaction between India and USA, there is a change in the definition of royalty. So I prefer to opt for that, definition and provision. So that is called as the ambulatory approach. So you have two approaches, static or ambulatory. How you can interpret the treaty. Now, very interesting point which I come after having all this understanding of treaty, and so now, by now I'm sure everyone is would have understood that there is a double taxation avoidance agreement, there is a domestic law, and what happens if you have a clash between these two? Between the double taxation avoidance agreement and the domestic law, how do you, which law prevails, and how do you opt for it, or what is the process? So few things which you need to understand is double taxation avoidance agreement is entered with a good faith of giving relief to the people or the enterprises involved. The assessee has been given the option to avail the most beneficial provision to itself, which means if the domestic law says, for suppose I take an example of royalty again. Now the withholding tax rate as per Indian law is 10%, as per DTAA is 15%. So option has been given to opt for such provision which is more beneficial to you. So I would compare between the domestic law and the DTAA, whichever is more beneficial. In this case, 10%, which is as per the Income Tax Act. So I would go ahead and opt for that beneficial provision. Right, so you need to DTAA gives you that you need to opt for such provision which is more beneficial. Let it be either in the DTAA or in the domestic law. Now, one important point you need to understand here is your domestic law should allow you for the creation of the tax liability. What I mean to say is there need to be a transaction which is taxable as per the Indian Income Tax Act. Then only you can go and refer to DTAA. It cannot happen that okay, my transaction, I have entered into a transaction with with the person in another country that is exempted in India, and still I'm going ahead and looking for some benefit in DTAA. No, your tax liability, a creation of tax liability should arose in your domestic taxation, and then you can move ahead and see if the DTAA is more beneficial to you or domestic law is more beneficial to you. So whichever is more beneficial, that would prevail. And we have got a numerous judgment, a numerous, and the latest judgment, the one which I gave spoke about last time, even the apex court has confirmed that whichever is the beneficial provision, an assessee can opt for that, right? So one needs to keep this in mind. Now let's understand how does the treaty making happen in India. So till now what we understood or we have been discussing is a very general provision. Now let's understand how does the treaty making happen in India. Can I just go and say that, okay, I want to create a treaty, I want to enter into treaty with this country? No, you have to follow certain, there has to be certain rights which have been given. So that right has been given by way of article 246(1) entry 14 of schedule 7, wherein if you can enter into the treaties and agreements with the foreign countries and implement such treaties, so parliament can make the law for entering into such treaties. So 246(1) of the article allow us to do that. Now, you know Indian Income Tax Act also provides the central government to enter into agreement with the country, and section 90 clause 2 gives you, like we have been discussing, that whichever is more beneficial provision, you can opt for that. So it does not happen just because I am telling you that, okay, see, you have this beneficial provision, you opt for this. It happens all through because of the law. There has to be a particular clause in the law which gives you the right to do that. Okay, so section 92 of the Indian Income Tax Act gives you the option that you can apply those provisions which are more beneficial to you. Now, as in my last slide, I have mentioned that Parliament can make a law for entering into treaty as well as implementing it. It is very surprising to note here, normally what happens if there is an agreement with any other country, we put it in we present it before the Parliament for the draft agreements are presented before the Parliament for their approval and for the sanction and all. But in India, as you see, in India, these treaties are not presented before the parliament houses. The central government has been vested with the power under section 91 to, go enter into such agreements, to approve, to sanction. So it is in India that the power to enter into such treaties is with the central government. Now, after understanding how a law is being created and what are the double taxation, very basics provisions, let me just give you how do you apply a treaty. I have a treaty. Now, suppose I have a client, Mr. A, who says, I am an Indian resident, I have an income in India, I have a consultancy income from USA. Now, you tell me, how do I, how should I apply the tax treaty? So, first step is you need to determine what is the nature of that income. You need to determine what is the liability, whether that is taxable, first of all, as per the Indian law or not. As I said, the liability need to be created via your domestic law. Then you need to see if there exists any treaty or not. In Indian Income Tax Act, yes, it is applicable, yes, it is taxable. Then I will go ahead and see whether there is any treaty available between India and USA. If the answer is yes, I will go on to check the nature of the income, what I determined in step 1, which article is applicable, as which article of India USA treaty is applicable to this nature of income. Then I have to go ahead and see if there are any clashes, like, or the conflicts, like, we discussed whether source conflict or residence source conflict, residence is whichever. If at all those conflict exists, we need to see how are we going to arrive at the conclusions, whether referring to article 4 or 23 or 21. You have to ascertain which is the taxing right that has been assigned, and once you arrive at that, then you will compute the income actually by giving that credit or following that taxing, assigning rights and things, and then you will arrive at the final income that shall be taxable and the final tax that will be payable. So, with this, I thank all of you for listening to me patiently for the basics of the international taxation. If you have any suggestions, queries, or if you want me to cover any particular topic on the international taxation or the double taxation avoidance agreement, or comparison between the domestic law and any article of the DTAA, please do suggest me via comment on this video. Do like this video and subscribe for CA Sansaar channel, so that you get to hear more and I get to learn from your queries if I can do something, if I need to improve on, or any topic that you guys want me to come up with. Thank you so much. Stay home, stay safe, stay healthy. Thank you so much.